time about 12, so I'll just go ahead and get started. Joe is a partner at Sputnik ATX, but he couldn't make it today. And if you guys want to meet with him another time, we can schedule that. But I brought two of our founders from our first class to talk to you a little bit about seed funding today. And if you have any questions about Sputnik, I can answer them. And so this is actually Joe's presentation that he usually uses. I went to this improv thing one time where the theme was where people had to have slides that they'd never seen behind them, and they would start presenting as they click through the slides. So that's kind of going to be how this goes today. So Kelly and Tom are going to talk a little bit about seed funding, seeing slides they've never seen, and then I'll talk about Sputnik and answer any questions you have. Go ahead.
Hi everybody, thanks for having us. Glad to be able to present something we've never practiced before. So as she's mentioned, we're both from the first cohort of Sputnik. I am CEO and founder of Pay. We give you credit card rewards on any debit or credit card that you currently own. And Kelly?
I'm Kelly Ernst, the founder of Redenim, and we are personal stylists for premium jeans using an AI platform called the Genome.
So, as she said, we're going to talk to you guys about seed funding and our experience and how it relates to these slides. So, cash is money. How you get money you need to grow. So, obviously, a lot of times, and I'm going to say from my perspective, sometimes people believe they need money to even start the business, right? Sometimes you believe you need to earn your seed so you can start getting things off the ground. But most times, a lot of times, and most of our cohort started off bootstrapping. So getting and making sure that there's a viable market available to your business, and trying to get traction early on so that when you go raise seed, they're not kind of brutally killing you on the equity and what the terms of the deal actually is. And so a lot of times, to scale is what you're going to be raising seed for. And I think that's very much what has been applicable to my company, is we started raising seed for our growth rather than kind of finding market product fit.
Yeah, I think one of the things that founders get away from very early on, especially first-time founders, is a truly validated product. We spent about a year validating our business model before seeking funding because we wanted to make sure that there's actually a marketplace for it. And this is something that I think a lot of founders think that they get, but don't necessarily hit it. Product market fit in terms of validation is when people are beating down your door to get what you're offering and you run out of it, or you can't build it fast enough, or there's demand is so high. And I think a lot of people believe that, I created a validation survey on SurveyMonkey, and 150 people took it and said that they want this, which is more or less what I did, the first iteration of this, and mistake that for product market fit. But when you actually have it, that's when it's time to go raise money. You can do sort of valuation that makes sense, as Tom had mentioned. And that's kind of the hardest part, I think, for a lot of founders, is bootstrapping through product market fit validation. And that's where you really prove your mettle as a founder in terms of resourcefulness. And that's something that I think a lot of investors are really interested in, is seeing that you're gritty, that you are creative when it comes to making ends meet in those early stages, and especially in places like Austin, where we don't necessarily have the deal flow that we do in Silicon Valley, where it might be a little bit easier to raise money without a product market fit in place. So we here in Austin have to be a little bit more resourceful.
So having said that, now that you know that you're ready to get funding, what kind of funding is available for you? And so one of the initial things, especially when bootstrapping, sometimes you can go and get a bank loan. And it's, I think, dependent on the kind of company that you're starting. These kind of different fundraising types might be fitting for you. The initial one, mostly before you go to institutional investors, they typically want to see, friends and family have been involved at some point. Because if your friends and family don't necessarily want to give you money and they don't believe in your product and your company, and the people who are closest to you aren't willing to give you money, it doesn't reflect well when you go for the institutional investors types. But at the same time, not everybody has friends and family that can give them money, and that's also a viable answer to reflect to the institutional investor and say, hey, I don't know people with money who can just throw that and kind of risk it with my company. But they typically look for that friends and family to some extent, or they want to see that you bootstrapped, like we said previously, and see that you were giving that kind of risk and you had that belief. Grandma's 401k, I personally won't recommend that. It's kind of like a reverse mortgage kind of thing. I don't believe in those, so I would actually not say go for grandma's 401k. But angel investors, they're always interested. They're looking for things. They'll write you typically a nice enough check that'll get you off the ground that you can kind of extend it to where you see it. Angel investors you typically can find either by reaching out through LinkedIn, or you can try and find a friend who has some kind of connection, and that's typically how even some of my friends who have been raising funds would reach out to angel investors I knew. It's kind of sending out to your network, sending an email with an explanation of what are the terms of your deal, why are you raising that money, and what is your company, and if you can make that introduction. And typically that person making the introduction will do that kind of small pitch for you. And there's a lot of angel investors here in Austin. I think kind of as you mentioned in Silicon Valley, it's a little bit easier on the institutional side. Here in Austin, I think what it's known for is more of the angel investment round. So you're going to find a lot more angel investors here in Austin who are happy to get involved. Venture capitalists, similarly, that's the institutional investors. Again, they're probably going to be more on the coastal regions. And they're going to be looking to hammer you for your equity, and so they're going to kind of fight back on that. You're going to want to prove that you have some traction, you have growth, and they want to see that your seed investment is going to go towards that growth rather than that product market fit.
I look at this as like an array of relationships, starting with kind of, cold, distant, not necessarily closely intertwined, to a very, very close relationship that you have with the capital that's coming in. So on the bank loan side of things, again, usually you have to be operating for about 2 years to secure a bank line or line of credit from an institution at that level. But a really good alternative to that, and like I say this kind of with a grain of salt, is business credit cards that are linked to your incorporated or LLC protected entity. This is a good way to finance little things when you are bootstrapping. You just have to make sure that obviously you can pay it, and you have either revenue coming in to handle that, or other sources of income to pay that down. It's a great way to get miles for things like traveling for meetings, which is what we did with our credit cards. It kind of financed a couple other little things in the business through points, which was interesting. But I think there's this general fear around creating a line of credit to finance portions of your business, and as long as you're very careful with it and conscious about the way that you're paying these credit cards off, it's a good way to get in the door with banks and create a relationship. So for example, we started with 2 Chase credit cards, and we are looking for a line of credit through Chase, which they may actually extend us because we have established that relationship in kind of a creative way. They saw that we were able to pay and have that relationship. Friends and family, again, we kind of look at this in the old sense of going to your rich friends or family members, of which I have neither, and asking for money. These are often F and F, dumb money relationships. But I think crowdsourced equity and crowdfunding campaigns also live in this realm. The SEC laws have changed to allow you to crowdsource equity and create a single LLC to represent a syndicate of investors, either in accredited platforms like Start Engine, which allows you to crowdsource equity, or something like a Kickstarter. What's really great about these platforms is they actually serve as a secondary way for you to further validate your product. If somebody on Kickstarter is willing to back you to the extent of like blowing through your minimum product raise, that is unignorable traction to a certain extent. And can actually help you leverage relationships further on with angel and institutional investors. Like any sort of product release, a Kickstarter or crowdsourced equity requires a well thought out marketing campaign to create buzz and hype around it. But again, if you've got traction on a pre-order side of things, it's a really powerful thing to bring to investors. Angel investors, again, usually They're not necessarily people who are industry specific to what you're doing. For example, I'm not really finding fashion investors in the angel level here in Austin. So it's a relationship that you have to manage. You know, you can take money from them, but understand the expectations, make sure everybody understands the expectations of both parties, that their return is not going to be immediate. They may or may not be able to provide advice or input, either be silent partners or active partners. It can be dangerous if you have an angel who wants to be super active in your business but does not come from the arena where you are operating. And so sometimes it's better to walk away from the check than run the risk of somebody attempting to micromanage your business and using equity in the company against you.
I think that's a good point too. You want to make sure that the terms fit your business, because it is very much your business is online. You're not just validating your business through the money that you raise. At the end of the day, you want to make sure that this is elevating your business to the next level and helping to grow it. So when you are raising money, ensure that the terms make sense. You can fit with this investor. It's a mutual relationship rather than a one-sided relationship. And I think you also mentioned crowdsourcing as another aspect, and that's a rather interesting component. It does validate your market, but it also could take a lot of funds to do crowdsourcing. It's kind of a double-edged sword.
It's a give-take, yeah.
Yeah, if it works out, it's phenomenal, but it will take a lot of your attention and time. So where the typical way of raising funds might take anywhere 3 weeks to 2 months kind of thing, going and crowdsourcing something could take a lot longer, because it is you're basically now selling the company rather than the product that your company sells. And so you're going to have to do a lot of marketing. You're going to have to do a lot of ensuring that you're following the SEC rules and the laws, and you're going to have to kind of make sure that there's traction coming in on that end. So you are kind of putting yourself at risk and a lot of your attention there. And funding alone is going to take a lot of your time. It's not that you kind of work on your company and you raise money simultaneously. It's more so when you're raising money, the one founder needs to be focused on raising that money while everybody else does everything else. This is going to completely take your time and your attention and basically your life for that time being. So ensure that when you're raising money and not doing anything else, because it is going to take a lot of time and attention. And I want to also expand, on the friends and family. You have to ensure that they're accredited investors, meaning that they fit certain requirements if they invest in you. Only when you crowdfund, you can follow those SEC laws that allow them to invest smaller amounts if they aren't accredited. But most times you do need accredited investors for friends and family. Equity versus debt. I'll let you take this.
Oh, thank you. Thank you. I have to remind myself here.
Can I ask a quick question about that? What are the implications if they're non-accredited?
Legal issues. So when you sign, let's say, SAFE, for them to be on your cap table, they will need to be accredited and represented to the SEC on your cap table as an accredited investor. So if they are making, a couple $1,000 investment, let's say for this given sake, $10,000, in order to assume the risk in SEC's eyes, they will need to be an accredited investor that can afford to take that risk. And so when you have, when they review your cap table, let's say when you go to institutional investors, or just, and you have to kind of issue out a notice of sale of equity to the SEC, they will review your cap table and they need to see that, you have accredited investors who have taken the risk.
But I've heard they can invest, but it's an accounting hassle.
They have to, there's an accounting problem with that in a lot of cases. Other investors that come on are usually really skeptical of it, and I believe there's documentation that they have to sign and file with the SEC acknowledging that they don't meet the requirements for accredited investment, and they agree to that, so they can't come back and sue you if you lose their $10,000, which they assumed the risk in doing so. So there are workarounds, but you don't want to run the risk of alienating further investment down the line because you took $10,000 from somebody who makes $40,000 a year.
Plus, you also have to assume the cost that goes with raising that $10,000. And this is actually a really interesting thing that nobody really tells you either. When you raise money, you have to know that the money that you're raising is worth it, because there is a lot of legal costs associated with that money being brought in. There's a lot of just accounting costs associated with bringing that money in. You need to make sure that you're willing to pay that expense for it. The legal cost of selling equity to a $10,000 raise would probably be $5,000. You lost half of that raise just to legal components within itself. So you always want to make sure that you are raising according to what the costs are. So something like that might be a safe, and that's something you do with Sputnik, is you raise on a safe note, and it makes a lot more sense for each party on that, and you don't need to go through all this legal stuff to ensure that the safe note makes sense, because it's a given known safe note that even Y Combinator uses too.
Yes, cost of capital can vary between like 7 and 20%, and that's something that you can iron out by having a really good relationship with a law firm, going in first and understanding, what is the projected legal filing fee for a raise at say $400,000, and they'll say, well, our billable for that is going to be about $7,000 to get that filed and ratified. What are the accounting expenses, and understanding that like a certain chunk of what you raise is going to go out the door immediately to administrative things. And you have to budget for that also. Luckily, at least if you have a good relationship on the upfront with your accountant and lawyers and all of those, you can at least get a ballpark figure of what that's going to be based on the raise. And that's important to have a lawyer that is familiar with startups and raising money, and not just some personal injury attorney who doesn't file these things regularly. Most lawyers know to a certain extent, given the amount of your raise, what it's going to cost to file on their end. So that's a good thing to have up front. All right, so equity versus debt. When you bring money into the company that is not revenue, it's got to come from a source, and either you're putting that in as a founder, you're bootstrapping it, to which you actually should be writing yourself promissory notes to the effect of how much you have invested in your own company, but it's coming in from outside investment, and there's two forms of that. So there's equity, which the shorthand of that is somebody is giving money to the company and receiving a portion of it in return, which will, in theory, increase in value over time as the company generates revenue, as they raise more money, et cetera, et cetera. It dilutes existing shareholders, which means everybody kind of loses a little bit of equity that they hold the more capital comes in. This is expected. Most founders, by the time they exit, will only retain about 12% of their original equity in the company, going from 100%. That's just something to come to terms with. A lot of people get kind of weird about control in this sense, but the reality is that if you're creating a high-growth startup, you have to raise money, you have to sell equity to get to a scale point. Very few can do it on bootstrapping and revenue generation alone. I think MailChimp is one of my favorite examples of one of the only companies that has done it successfully and to the same scale point as an otherwise funded company. This doesn't have to be paid back. The expectation is that it is invested in the company, it's going to be used for growth, marketing, payroll, et cetera, and it is not going to be paid back to the investor in a cash amount in the traditional sense. They will receive equity for their investment, and this ensures that everybody has skin in the game, that they're invested in the success of the company as much as the founder, because they want to see a return on the actual shares that they hold. This must have a valuation. Again, the exception is a safe note, but the idea is that to know how much equity you're getting for an investment, you have to know what the company is worth. This is more art than science on the early stage of things, until you actually have revenue, meaningful revenue that you can project out your valuation. It's kind of a shot in the dark, which is where the safe note comes in, where an investment is made in the company with the expectation that it will have a valuation later on, and at the next conversion event where a valuation is defined, their initial investment will convert at that rate. So,
I have a question on that. So when you say Sputnik has you do a safe, is that the investment that Sputnik makes in your company in the form of a safe?
Yep, so it's $100,000 invested on a safe note, and the idea is that when we raise our next round, say at a $5 million valuation, their equity will convert at that valuation. That has a cap though, it's 4.5. So it would cap out at $4.5 million, and they receive the equity for $100,000 at that valuation at the time.
Have you found, I mean, as I've talked to investors in Austin, very few know or are comfortable with the safe note. So have you guys found that to be challenging as you talk to other investors in town to sort of have a a type of investment on your cap table that they don't understand?
Yeah, so what I would say about safe notes is it's actually becoming pretty standard, especially in the tech community. So when you're raising, and it was established by Y Combinator
Yeah, I
initially,
understand
right?
what it is, but like CTAN says they never accept them.
So there's also aspects in which some people in an angel investment round will give you a safe note, but they'll give you a safe note where their conversion happens and it's non-dilutable. And so typically at that time, they won't feel comfortable. But knowing the terms of the safe note, more than half the time, institutional investors would be fine with safe notes, especially early on when you're doing, your seed, your pre-seed, stuff like that. And more than half the time, it only makes sense with angel investors to give them a safe note because anything else wouldn't make sense to raise money with them. The other thing, which I bet might be the concern for some of these guys, is there's a difference between a safe note and a convertible note, right? And so
They're familiar with convertible notes.
right. So convertible notes, and sometimes they mix it up though, is that convertible notes are, safe notes are assumed to be convertible notes, right? When they convert, sometimes they assume that they're debt. I'm not saying that they are. I'm saying the assumption in their heads more than half the time is that they're very similar, if they're not familiar with safe notes. Did that make sense? Is there anything?
I was sort of curious if you just had personal experience.
Oh, no.
I mean, I understand what a safe note is and a convertible note is, and I've heard, CTN is very, we're in the CTN process right now, and they said very specifically their investors do not do safe notes, and that's the largest angel investment group in Austin.
Oh, you're asking if they do safe notes themselves, or if you have cap table?
My question is, have you found that
I guess
that's
No.
a problem with that as you've been raising in Austin?
Not personally. I think it solves the problem of overvaluation early, which is just as risky. But because this is a new sort of way to raise funding, who are extremely conservative with their investments, right? I think the issue with the safe note that concerns them is that a lot of the other parameters can get out of hand really quickly. So if there's not a defined cap, or if there's like a cap that's too low, it can be very limiting to the equity pool that remains for additional investors to come on. If there is an anti-dilution clause in it, which I will not sign a safe note that has, or any note that has an anti-dilution clause on R, and if they make sense in the context of the business at its stage. So for example, our safe notes, I think for most of us was our first investment that we received. We didn't have revenue to create an accurate projection of valuation at the time, but the way that the note was structured included a cap which defined the absolute maximum equity that Sputnik could potentially receive, which is very transparent to additional investors and understood. It's reasonable, it's low, but it's reasonable, again, given limited valuation. But I think as more mature and seasoned investors that have been more conservative in the way that they write the terms see more of these, and they'll get more comfortable with it. But yeah, it's just making sure that that cap and anti-dilution is,
And that you can explain it to the investors and the others.
Are you presenting them the safe note, or you're saying
No.
you had previous people with safe notes and they're not interested in?
They just said they
Understand.
won't look at them. They won't consider companies that want to raise with a safe note. They'll only consider
Yeah.
equity
Yeah,
or convertible
okay.
note.
So I understood it that you had people with safe notes on your cap table and they weren't
No.
interested. Okay, no, I'm sorry.
So, are safe notes, do they have anti-dilution typically, or no?
no, that's usually a preference of a particular investor.
I don't know if anybody goes with that.
There's one in town who's notorious for it, and it has been.
I mean, if it's Elon Musk giving me money, I'll consider it anti-dilution.
Right, I mean, it's a very, very, very specific scenario where that would be acceptable in the long run, because anti-dilution is a good way to drive off future investors. It's a good way to annoy and alienate your legal team, and it's a way to back yourself into terms that you can never undo. I know DLA Piper has reversed a number of anti-dilution contracts in place to the extraordinarily expensive detriment of the company. And again, this is something in the cost of your capital that you have to consider. Anti-dilution in equity costs you money. And so even if somebody is writing you a check for $50,000 or $100,000 or giving you free office space and sneaks an anti-dilution term into the note, You have to really think about how desperate you are, how worth it to you that is, because the long-term success of your company, literally make or break, can depend on your ability to raise money in the future without somebody bogging you down. Okay. Yes, and which I might improv. Okay.
Less is more. Okay, so this is an interesting thing. So one of the things that is being said here is be good at storytelling with your product. Yes and no. If you have growth, growth speaks for your company. If you don't, then the story does, right? So it's you can replace it either way. Sometimes your product just is a very logical product that has a product market fit. There's no emotional story to tell behind it. It just makes sense. You don't need to be good at storytelling to be able to persuade someone to A, either use it or B, invest in it. It makes sense. You have traction. So as long as it's more coherent in how you're presenting it, I think that's valid in that context. Less is more. I definitely believe in that. I think even from any design perspective to the way you tell your story to how you explain things, unfortunately I'm bad at that part. I think less is more is always very much true. Keeping it simple is always the best way, and answering questions thereafter and expecting those questions is the best way to kind of dunk on that part. I'm here to show you how I intend to use the money. You definitely need to tell people how you intend to use the money that they're giving you. That should kind of be obvious. They don't want to see you just kind of spending it. They want to know that you know what it is going to be spent on, because again, they're going to be viewing this as a way to escalate the company and kind of empower you guys to keep doing what you're doing. Therefore, they want to know what is it that you need to do to take it to that next level. So you always need to know, alongside your benchmarks, how you're doing right now and what you could be doing if you had that money, kind of thing.
Yeah, this is pretty straightforward stuff that I feel like most founders, you're capable of building the product that you have an idea for. Lots of people have ideas. They're not capable of building them and not capable or willing to do the work to get it done and invest in something that is right alongside your cap table. We use captable.io, which is a phenomenal way to keep track of everything, including your funding rounds, and you can file the paperwork right there to have your cap table blessed by the government. I don't know who does it. I just send it on, and I'm like, okay, it's been ratified. Don't overvalue your company. This is really, really, really important, and why valuation is so tough in early rounds, and why it's also very dangerous is if you overvalue your company and you sell off equity in it, and you come back and you're not able to meet the revenue requirements to justify the valuation that you gave yourself, you have to answer to your investors, and it can be very nasty going forward. You can drive yourself into down rounds, which is bad, I've been told, but but really, again, valuation, art, not science early on, but give it your best guess. You start with, for example, your projected revenue in the first operating year of your company, which is usually going to be just a shot in the dark, and you multiply that over time and growth, and back into, okay, my valuation is, if you start with $250,000 in the first operating year, extrapolate that out over time, come back with $3 million valuation. So it's like 5xing over 3 years, giving you a very conservative valuation of about $3 million. You at least have something to work with. Again, this is why safe notes are great until you have actual revenue in the door. But if you're saying, my company is worth $10 million and you haven't generated a dime of equity, and then you go to Silicon Valley and raise money on that, and then blah, scary.
We just heard the opposite from one of the speakers this morning on you don't want to undervalue your company as well, because the multiples.
Because then you give away too much equity.
Yeah, well, and like I've heard that the cap that you choose on the business is a de facto valuation for the future. So
correct.
If you're getting ready to raise your first equity round at $10 million, he said if you valued yourself at $2.5 million, or you put a cap on it at 2.5, that sometimes you wouldn't be able to secure the financing,
right,
because the future investors would think that the guys on the note were getting too good of a deal.
Right, and that's
What's
true.
your thought? Yeah. So how do you strike that balance? How do you guys deal with that issue?
It's tough, and again, the best way to do it, even if you're just getting 6 months worth of revenue, and again, just making it happen to get something out the door to get money in. That gives you a better projection of your actual valuation. Again, yeah, too low, you give away too much equity in the company. Too high, you run the risk of not being able to raise money in future rounds at an expanding valuation.
It sounded like you guys took 4.5 million as your cap. Was that negotiable, or was that just, hey, you want the money, you take it?
In terms of
How did
the
that
safe
work?
with Sputnik, it's pretty set. In terms of raising safes out thereafter, you can determine that kind of as the terms with that investor. To kind of go off of what you're asking though, how do you value your company? The one thing, most of the time is you're not going to undervalue on the second time around. If you get to a point where the people who originally came in get such a great deal, and that if you want to get on the train, we can get you that next 20-time return, because this is what we've done with the money previously. This is what we're going to get next. And if you don't want to miss out again, then you might as well get in on these terms. Because if you do have something where the valuation is returning to your previous investors, like 50-time return, then you probably more than definitely deserve the terms that you're saying for the next round, because you've done a great job there and there's a lot of traction going on and stuff. But you need to be able to make sure you're vetting that value, right? Like you've said that our revenue has grown 200 times, or our traction has been this and that, and we're valuing based off of a PE ratio of, I don't know, like 2 or something like that. That's how we came to this valuation. You need to be able to back up whatever you say with actual kind of KPIs or benchmarks or stuff alongside the company that say this is why we believe this, because of blah 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 blah.
And at the institutional level, a lot of those investors that come in early will reinvest, and they'll be given priority and discounts and other incentives to reinvest in the company going forward. And I've seen that with a number of companies where their investors come in with a really good deal and a moderate valuation on the company, and then they will be the first one to lead this Series A and pull together the syndicate that continues to raise, because they'll be given, preference, priority, boarding, or whatever, and a discount on their further equity, so they can choose to, at the conversion event of their next raise, convert their equity to stock or reinvest, and many of them will reinvest, given the expectation that your valuation, profit, revenue will continue to grow, again, given the influx of cash. So it becomes this relationship you can never get out of.
I think also, to give even better context, when Dropbox originally raised, I think their first raise was $1 million at a $4 million valuation. I think anybody now would take that because they IPO'd not too long ago at like a $10 or $16 billion valuation. So, I don't think, they were able to go alongside the next few valuations because they were able to prove what they do with the money and where the company is. And again, the company it speaks for itself when you go into this. So you want to make sure that you're valuing it with an understanding of what your company is, what you have projected for that company, at a rather conservative financial projection for itself.
We're all really diverse here, like we're all in different industries. Do you find that there's a place where we can all go and say, okay, well, we're in life sciences, we're in tech, or whatever it is? Because we had a fellow here who spoke to us, I don't know, 3 or 4 weeks ago, who said, oh, you're a life science company, pre-revenue, you're worth $5 million. And that's like the your average,
So I think it's an application of what is the vertical of your business, what is the industry that your business is in, because then that also determines how much money is being thrown into that vertical, right? So like you said, life science, being pre-revenue and getting a $5 million valuation, you will go through due diligence to see and vet out why is it exactly worth that $5 million base, right? You need to have done some kind of research, some kind of knowledgeable,
comparable,
right, to be able to say we are worth at least a competitive base for everybody else. let's say you're doing a blockchain Bitcoin company, right? You'll probably see pre-revenue valuations similar depending on what investors you speak to. And that's because, again, it's a hot industry. There's money being thrown around in it. People are willing to give it so that they can get in it quick because, again, FOMO, they don't want to miss out on this stuff. That's just how it goes. But if you're doing, I don't know, something that used to be really crazy, but people no longer kind of invest in it as much as they do. I don't know, Yelp. If you're doing Yelp again, they're probably going to be like, oh, we've seen this proven out. You have hard competition coming along. They probably won't give you that $5 million valuation coming in. That's just something to consider. So it's dependent on what is the industry, how big is the industry, how much money is being thrown around, how active, what's the volume in that industry. That will determine a lot of what the valuation is.
Yeah, and you have on your earlier slide benchmark. So your milestones that your company has achieved over time without additional revenue, do those play into your valuation as well? I mean, in life sciences, there's some pretty lofty milestones that you have to reach, and if you reach them, then, I mean, I've seen companies, be 50 million pre-revenue in life sciences.
Yeah, and the things to consider in those is that sometimes they have patents, sometimes they have something substantial to show that there's less competition, and therefore that valuation will go up even if you are pre-revenue. There are ways in which you can set up your business to have that high valuation without even generating revenue. But it's all based off of, like you said, the benchmarks. You need to have something to show that either you kind of outpace the competition, you have that traffic, again, that traction, you have growth, and the anticipation and the viability for that revenue to come in will then be able to adjust. I mean, think, again, Snapchat is a phenomenal example of this, right? They IPO'd at a $26 billion valuation on shares that made no sense whatsoever, and they got it, right?
Yeah.
They weren't making any money. They were hemorrhaging a lot of it, but they had that massive valuation. And because they still had about like 126 million active users, they have a lot of influence digitally that allowed them to get that out. So those are things to consider. As you can kind of corner your competition, you can kind of show that you have a lot of traction and benchmarks available for it. Yes, your valuation will go up.
Yeah, you can use pipeline as a way to generate a valuation. We're consumer-facing companies, and what we used to kind of determine our early valuation was the value of a wait list that we had built up, and placing a pipeline dollar amount on every contact on the wait list, compensating for conversion and likelihood of people ordering, what our average purchase value would be, so on and so forth, and extrapolating that over the first 2 quarters of the year and saying, okay, this is what we can expect. Given, even in the life sciences, there's got to be some way for you to quantify your pipeline, whether it is the value of a patent that you have in place or business relationships that you have set up with, clients who want or are willing to prepay for what you're building, etc. And it's really just a way to, log and create a dollar amount on
We've
that.
had companies prepay us, but they didn't ask for a valuation. All they asked for was favored nation status. So,
Right. So then you say, okay, so we have 10 big clients that have prepaid to be on the platform at and I'm just pulling this out of nowhere, $25,000 per customer. And then you say we can grow, we can acquire new customers at a rate of 10% week over week at this price, and we'll be generating revenue in 12 months at this. You look at that pipeline potential, and it's going to be wrong. It's always wrong.
Yeah.
It's just a wing in the park. But as long as VCs can see that you're making the effort to set benchmarks and goals for yourself, like, hey, I want to onboard 50 new corporate clients by July of this year to satisfy a pipeline of $800 million, or I don't know, whatever it would be. Okay, now we can back into a valuation based on that. So I think that might be a good way to go about it, is look at your pre-sales, look at your ability to acquire customers post pre-sales or continuing to build up a wait list. interest in placing a dollar value on that revenue going forward, our potential revenue.
So on that pipeline, that's more for B2B, not so much B2C, because we're doing customer discovery and gaining and doing a survey at the end of like, would you buy this if it was out there? And we have like 89% saying yes. Is that a possible B2C approach, is being able to show that wait list and the percentage of how many would buy it?
That, I think it exists in both B2B and B2C. It's pre-sales. That, to me, sounds like not exactly product market fit.
Okay.
Will anybody actually give you money for it now? You know, it's not, would you pay me? It's, give me your PayPal. And like, I'm not kidding. Like, it's as bold as that, because that is when you know you have product market fit, is when just from a concept in a survey, somebody is like, I will give you $15, I will give you $5, I will give you $50 to reserve this in the future.
So a Kickstarter campaign is a form of marketing. If
Yeah.
you did a Kickstarter campaign and had success, that would show
Yeah, so
something for an angel.
exactly. So that's product validation at that level. An angel, you know, could see that as product market fit. Again, if you really have product market fit, you don't even need to go through the whole pomp and circumstance of having a Kickstarter campaign and marketing behind it. If the market really wants what you have, you put a PayPal at the end of a survey and people will pay you for it. Or you can ask, you know, what would you pay for, make the tweak, go back and be like, okay, now I'll take your money. And it's bold. And I think a lot of people kind of shy away from that because they don't want to be like, oh, I don't want to ask for money for something that I haven't built yet. People do that all the time in the Valley and get away with it. And worst case scenario, so say I've got a wait list of 5,000 people, and each one of them paid me $10 to get this product built. You use that money to extrapolate your valuation.
How to
How to
find them.
find.
Yeah.
Crunchbase is like Tinder,
There's an app that you just literally look for.
but it's better. The
Think
internet.
like a crocodile.
This is great. Be a predator.
Hang out where angels and VCs hang out, but you need to know where they are in the first
Love it.
place. So that's kind of
Hang out where
Sit
angels
there.
and VCs hang out.
The
Golf
internet.
clubs.
yacht clubs. If
Yacht
you
clubs. Golf clubs.
that's what it is. Yeah. So the best way to kind of start a relationship with a VC is typically, as everybody else says, you know, have a friend introduce you, have someone outside from their network that you guys mutually know to introduce you. But what about those crazy moments where none of your friends know VCs either? That's probably a little bit more applicable to people. So the internet is a beautiful, innovation in the world. That
If only we had a device that was connected to an infinite web of information at our fingertips. Somebody build that.
there are VCs here in Austin that invite you to send you their material through their website. So basically cold emailing them, it works less than 1% of the time if you don't really have much, but it works to a minimum degree, right? The best way to then hemorrhage whether or not they will respond is to then follow up on LinkedIn and add them, kind of send them a note, don't just add them, kind of make that introduction very briefly so that you get that introduction. I've heard of a really funny way to do it, there, with the ability to kind of directly attract to specific people, contact me kind of thing. I've seen that happen before. It's hilarious. It actually worked for that person. So getting creative with how you kind of get in front of that person is really useful and beneficial. Otherwise, a lot of them are active on Twitter too, so kind of interacting with them on Twitter is a great way to then get that to get that engagement. The one thing, though, to take in consideration is you don't make the first time that you approach that person with, hey, I got this great company, invest in me kind of thing. You start a relationship like you do anything else, and it's typically better to start that relationship before you're raising money. So kind of reaching out and saying, how is everything going? Love this post that you made, whatever it is. Just want to put you on notice about what we're doing, and this is who I am, and all this stuff. We're going to be raising in 2-3 months. Love to follow up with you.
We came across,
most of us have been using, you have all of those investors, and you can feed that into a CRM and keep track of it.
Yeah.
It's been crazy because I've been getting a lot more responses because of that platform, but it's something everyone should check out. One thing we use Founder Suite too. One of the things that we do on top of that is do an investor newsletter. So it's not like you just kind of like send out something. You're kind of updating them on what milestones you've accomplished before you even ask for money. And typically you'll find that they'll reach out to you and be like, oh, this is really cool. Love to learn more. Send me your deck kind of thing. So the investor update is widely popular and useful. And typically you also want to have a call to action at the bottom that isn't even related to raising or anything. It's just a call to action like, hey, do you know what my competitor was valued at this most recent round? Or do you know this kind of person within this? They'll respond. That's a great way to kind of get that connection going.
For startups that are new to Austin, what are some of the big areas, like you say go hang out with them, where are the places that are really popular for?
A lot of VCs will host events, open houses, discussions, things like this, believe it or not, as kind of their pipeline. And so it's good
How do you find that?
You make a list of, okay, all right. No, you make a list of like VCs in the area that would be interesting to you. So say, for example, Live Oak, and you want to get an intro to Live Oak.
Skip speaking. Sorry.
I'm an investor there. Just like go to their website. A lot of times they'll have events that they're doing. Look at them on Twitter. Look at the partners on Twitter. Look at them on LinkedIn and see what they're posting about, because if they're having events, if they're trying to get people networked in together, they're not going to not say, they'll talk about it. And it's just kind of a little bit of sleuthing. That's literally what I do. I've been stalking a VC in the Valley, and
Personally and
for pretty attractive, like whatever. And he just hosts these events with General Catalyst, and I'm like, okay, I'm gonna align a trip to the Valley out when one of these events is being held, go introduce myself, but like follow everything in the meantime. That's the way that I've been able to find events with VCs in town, and that's a good way to kind of like firsthand do it. Capital Factory does a lot of things.
You do stuff.
They do stuff, events, which can be kind of like hit or miss in terms of actual value, but there's a few key people to know there. Like Gordon is really plugged into the angel and VC scene. He's wonderful to talk to, and can kind of connect you around. So again, you have to place value on your time, and the inevitable cost of capital, and part of that is the effort that you put into getting it, and really being intentional about the way that you reach out to people, the events that you attend. But like meeting people in person is like the #1 best way to go about it. And then the second one is warm intros. So again, I have a running list of angels, of firms that I want to raise from, and I go on LinkedIn and I stalk every single one of the people involved, from the receptionist up to the general partner, and I find my second degree connections and ask, can you introduce me to Ashton Kutcher? Has not happened yet, but I've gotten other introductions that were just as good in the long term. Also, in addition, like to the whole Founder Suite thing, like setting up your outreach as a CRM tool, like with a CRM tool, is like the best way to do it. Just literally treat it like, if I could afford Salesforce, I would do it for just interacting with VCs, because you can track and manage everything, you can automate stuff, you can like send out your updates, you can follow up, you can see who opened your emails, who clicked on stuff, and like customize that interaction and just keep it organized. Fundraising is a full-time job for one of the founders, and the more organized and intentional you can be about it, the better.
Are there bird dogs in Austin? Are there bird dogs? In other words, someone who's connected into the whole pipeline, and you can go to them and say, hey.
There's a couple key ones. I think Gordon is a good one.
What's Gordon's last name?
Doherty?
Jordan.
Don't make jokes. That's my job. We talked about this in a whole thing. No, is that solicited? Yeah. I just need 10% of the raise, and
it needs to reach a certain amount of a raise too. It needs to be a certain amount of raise. You can't go to them and be like, hey, we're raising $1 million. I'll give you 10%. Typically, it won't be 10%. That's outrageously high. It's typically like 5%.
I think in Texas, the law is 5.
Yeah, there's protections in place. You can go the broker route, but founders can still be successful.
Are there brokers in?
Yes.
I think accelerators might be.
Accelerators, yeah.
Oh, that's also a good point. Yeah, you want to join accelerator programs, especially if you're new to Austin. I was new to Austin. I actually moved here in January to join Sputnik. I'm originally from Los Angeles. And so, yeah, so the network is interesting in Los Angeles, but in Austin, it's a much more exciting place, I think, because it is much more early stage friendly. And so when you join accelerators, when you're part of the communities and where there's a lot of startups, you start to get those connections. So me coming into Austin, I didn't really have any of those connections. Sputnik definitely helped us quite a bit in making those connections and introducing us to investors who had heard of us and were interested in learning more about us. Otherwise, I'll just be around her more than half the time, and she sells my company better for me than her. So.
Yeah, no, accelerators are a great way to plug in and get targeted mentorship. It sounds like that's a lot of what's going on in Mass Challenge as well as funding and introduction to VCs following the program.
Parting tips. It sounds like you have to be very social when you're raising money. One thing I would say is you don't have to be obscenely social. You don't have to be necessarily a very social person. You can be a little bit more relaxed. Like you don't have to go to every party and every event to try and meet these people. Just make sure that the connections you make are the connections that you will manage and maintain, and those relationships will help you excel forward. Don't be a jerk. So don't be me. Don't be rude and obnoxious, but be nice, accommodating to every person you meet, not just VCs. Don't be sensitive to angel VC time. Yes, but also take in consideration it is a mutual relationship that you're moving forward with. If the VC is a jerk to you, that VC will be a jerk to you when they give you money, and that relationship will crumble. So just be considerate of their time, just as they will be considerate of your own too. Good rule of thumb: if you get an email from a VC, you respond within 2 days max, and 2 days is still kind of on the long time, just as they will respond or should respond quickly to you. Don't overvalue your company, obviously. Don't complicate your cap table. That goes back to don't get people who won't be diluted. Don't make outrageous instruments and outrageous terms. Keep it simple. This is seed. This doesn't need to be something that just ruins it for further, because then nobody's going to get back the return on investment that they're hoping. High growth covers a multitude of sins. High growth covers everything. High growth, if you have stuff that shows that your company's taking off, that you have traction, you don't need to really, as we've said before, to show all those other things. Growth will speak larger than the words in the story of your company.
Mm-hmm. Yeah, I think the important one here too, ask if you don't know what something means.
Yes.
Super, super important. Same thing, sort of same vein here. If you're asked a question, if the VC asks you a question, you don't know the answer, don't say I don't know, and don't make something up, because that'll come out in the wash. Just say I will find out and I will get back to you as soon as possible. And that is probably the best advice I can give in those conversations, because you will be confronted with things that you don't immediately know the answer to. My brain is cloud-based, so things just kind of like come and go as I make room for them. And yeah, sometimes I'll get a question that I really don't know the answer to, but I will immediately after the meeting get an answer and send it. Another important thing too is ask for help if you need it and when you need it. Having advisors is really phenomenal for this. I actually just hired my advisor to be the COO of my company because he was so active in all of my meltdowns. And I realized that he's a problem solver, and he's someone who just does things systematically, where I'm more visionary. He's more, let's pay our taxes, and that's great. But for so long, I felt like I couldn't ask for help because it would reflect on me as a poor founder, what CEO doesn't know this, that, or the other thing. that you can back yourself in some really bad corners not asking for help and advice. So I would say get an advisor or two who's really invested in what you're doing. If they ask for money, tell them to eat your shorts. But take a hike. Kiss my grits. What else have I said lately?
But I kind of want to add on to the
course
stuff
you
you're
do.
saying.
Aw.
So the one thing to consider too is that when you're raising money, and this is your first time as a founder or even raising money, the VCs are still going to be open. So don't feel like you have to be this, well-suited person that knows everything about anything that has to do with startups. I mean, they're understanding about, this is your first time. They deal with that quite a bit, right? They're investing in early stage companies, so they deal with that very often. You don't have to feel like your time is very important and all this stuff. Just be a person, be kind, and show them what you're doing, and they'll appreciate it, especially if they're good VCs. They'll understand. So you can go back to you.
No, because it's gone. So.
Yeah, well, that's it. Thank you guys.